Why your risk tolerance matters more than you think. So you are ready to take the plunge into the world of investing. That's fantastic. But before you dive headfirst into the stock market, there's one crucial question you need to ask yourself: how comfortable am I with risk? This isn't a hypothetical either. Your risk tolerance is a fundamental factor that will shape your entire investment strategy. Let's break it down. Risk tolerance, your investment personality. Think of risk tolerance as your comfort level with investment ups and downs. Are you someone who gets heart palpitations at the sight of a red arrow on your stock chart, or do you see volatility as a chance to snag some bargains? Investors with a high risk tolerance are comfortable with potentially significant swings in their portfolio value. They might be drawn to stocks, which offer the potential for high returns, but also come with the risk of high losses. These investors might also consider venturing into exciting, and potentially riskier, areas like real estate investment trusts, REITs, or cryptocurrency. On the other hand, conservative investors prioritize stability. They might favor bonds or other fixed income investments that offer lower potential returns but come with less risk. These investors might sleep soundly at night knowing their principal is relatively safe, even if the growth potential is limited. Time horizon: investing for the marathon, not the sprint. Here is the kicker: your risk tolerance isn't set in stone. It can be influenced by your time horizon. If you are a young professional with several decades until retirement, you can afford to take on more risk. The stock market has a long history of rewarding long-term investors, and you have time to weather inevitable downturns. The potential for higher returns through stocks and other growth-oriented investments can significantly boost your nest egg over the long term. However, if you are nearing retirement or saving for a short-term goal like a down payment on a house, you might not want to risk your hard-earned cash on volatile investments. Sticking to safer options with a guaranteed return, like certificates of deposit, CDS, or high-yield savings accounts, might be a wiser move in this case. Even if the growth potential is lower, you'll have peace of mind knowing your principal is secure. Building a strategy for your risk appetite. Now that you understand the importance of risk tolerance, how do you translate it into an actual investment strategy? Here are some tips. Take a risk tolerance assessment. Many online resources and financial advisors can help you gauge your risk tolerance. This assessment will consider your financial goals, age, and overall comfort level with risk. Asset allocation: the heart of your portfolio. Once you understand your risk tolerance, you can use it to determine your asset allocation. This refers to the percentage of your portfolio invested in different asset classes, such as stocks, bonds, and cash equivalents. Investors with a high risk tolerance might allocate a larger portion of their portfolio to stocks, while conservative investors might lean towards bonds and cash. There's no one-size-fits-all approach, but the key is to choose an asset allocation that aligns with your risk tolerance and time horizon. Diversification: diversify, diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes, such as stocks, bonds, cash equivalents, and even real estate. This diversification helps mitigate risk because when one asset class dips, others might perform well, helping to balance out your portfolio. Rebalance regularly. As market conditions change, your portfolio allocation might drift away from your target asset allocation. Rebalancing involves periodically buying or selling assets to bring your portfolio back in line with your risk tolerance. This ensures you don't stray too far from your comfort zone. Remember, investing is a journey, and your risk tolerance is your compass. By understanding your risk tolerance and crafting a strategy that aligns with it, you'll be well on your way to achieving your financial goals. Beyond the basics, refining your investment strategy. As you gain experience and your financial goals evolve, you can further refine your investment strategy. Here are some additional considerations. Risk-adjusted return. Look beyond just returns and consider risk-adjusted return. This metric takes into account both the potential return of an investment and its level of risk. For example, a high-risk investment might offer a high potential return, but it also carries a greater chance of significant losses. A risk-adjusted return metric can help you compare different investments and choose those that offer the best return for a given level of risk. Investment fees. Don't underestimate the impact of investment fees. Fees can eat into your returns over time, so it's important